Okay, let's unpack this. We're doing a deep dive into a review of a book that, well, it takes aim at one of the most powerful and, let's be honest, often mysterious institutions, the Federal Reserve.
Right. The book is Christopher Leonard's The Lords of Easy Money. But our source today isn't just any reviewer, it's William Poole, who was president of the St. Louis Fed from 1998 to 2008.
So he was there.
He was absolutely there, at the table,
Hmm.
sitting alongside one of the book's key figures, actually.
That insider perspective is crucial. Our mission here is to pull out the essential insights from Poole's review, maybe cut through some of the debate he flags, and figure out what this clash of views means for how we understand the economy and the Fed's role in it.
Yeah, get ready for some maybe surprising facts and possibly a few aha moments you won't get just by skimming the headlines.
Sounds good. So where does Poole start? How does he frame Leonard's book?
Poole basically boils Leonard's book down to two main narratives. The first focuses on Thomas Hoenig, who was the president of the Kansas City Fed.
Right, Hoenig, known for dissenting.
Exactly. Leonard zooms in on Hoenig's repeated dissents at the FOMC meetings, that's the Federal Open Market Committee, where they set interest rates, this was back in 2010.
Okay, dissent at the FOMC. What's the second story?
The second thread follows the financial journey, you could say, of a Midwest manufacturing company called Rexnord. Leonard describes it as being repeatedly refinanced into, well, higher and higher debt by its owners.
Interesting pairing. A Fed dissenter and a manufacturing company's debt. How does Leonard connect them?
The connection, according to Leonard, is Jerome Powell.
Ah, the current Fed chair.
Well, Fed chair from 2018, yes. Before that, he was a partner at the Carlyle Group, focused on industrial buyouts from 97 to 2005. Then he got appointed to the Fed board in 2012 and eventually became chair.
So Powell bridges the world of private equity, like with Rexnord, and the world of the Fed, where Hoenig was raising flags. Got it. Now, Poole knew Hoenig personally.
Oh, yes. They served together on the FOMC for a decade, from 98 until Poole retired in 08. Poole says their working relationship was cordial, and their basic views on monetary policy were, compatible.
But I sense a but coming.
There's definitely a but. This is where Poole's review gets really interesting right away. He argues that while Leonard tells compelling stories, they don't actually capture Hoenig's real intended message.
So the book missed the point of its own central figure's dissent.
That's Poole's view. And he also suggests that Hoenig's policy position itself, the one he was advocating back then, might not have been completely sound anyway.
Wow, okay. That's a significant critique from an insider. And Poole had other issues with the book itself.
He did. Coming from an academic background, he expresses, let's say, significant frustration with what he calls an almost total void of references documenting the facts asserted in the book.
Right, academics like footnotes.
They do. For Poole, that lack of documented evidence was a major stumbling block. He found it profoundly frustrating.
Okay, so he wants the evidence. Let's turn to Poole's own analytical framework, the lens he thinks is missing. He uses an anecdote, right, about a ship.
Yes, a really vivid story about a Delaware Bay pilot. Poole recounts this pilot describing bringing a huge, heavily loaded oil tanker into harbor at high tide,
Sounds routine, maybe?
except the ship's reverse gear was broken.
Oh, okay, that's not routine. Navigating a giant ship into a tight harbor without brakes.
Exactly. Terrifying, like you said earlier. They had to come in fast, full steam to make the dock before the tide turned. No reverse meant they needed a whole bunch of extra tugboats and some incredibly tricky, precise maneuvers just to avoid disaster.
I can picture it. So how does a broken reverse gear connect to the Fed?
Poole uses it to illustrate a fundamental idea in economics: policy instruments versus policy goals. The idea is simple but powerful. You need at least as many distinct policy tools or instruments as you have policy goals if you want to achieve all those goals at the same time.
Makes sense. For the ship, the goal was docking safely. The instruments were the rudder, the forward engine.
And the reverse gear, which, you don't need much out on the open sea, but it's a critical instrument for the specific goal of getting into a harbor safely.
And Poole's point is that people discussing the Fed, including Leonard in his book, often miss this. They talk about goals like low unemployment or stable prices.
Or even as Leonard does, distributional outcomes like who gets richer or poorer.
But they don't stop to ask if the Fed actually has enough separate tools, enough levers, to hit all those targets simultaneously.
Precisely. Poole says that the reviewers, and Leonard, didn't really analyze Fed policy through this instruments versus goals framework. Instead, they focus a lot on things like distribution.
And crucially,
And crucially, Poole notes, Neither Leonard nor the reviewers nor even Fed leadership since 2008 seemed sufficiently focused on the dangers of inflation. Poole argues that was Honig's primary concern back in 2010.
Okay, that's a really important distinction Poole is drawing. Honig worried about inflation first, not distribution, and we need to think about the Fed's toolkit. Let's dig into Honig's dissents more. How does Leonard portray them?
Leonard paints Honig as trying to stop a looming catastrophe. He describes this catastrophe as being driven by a combination of big banks on Wall Street, the stock market, and the leadership of America's Federal Reserve Bank.
That's quite a claim. Does Poole buy that specific framing?
Not really. Poole pushes back. He points out, look, Leonard offers zero evidence that big banks or the stock market were actually driving Fed policy then. And he notes the Fed chair at the time, Ben Bernanke, was an academic, not some Wall Street crony.
So Leonard's interpretation focuses more on the effect of Fed policy, this allocative effect.
Yes, exactly. Leonard's argument, as Poole reads it, is that Honig was concerned that Fed policies weren't just about overall growth, they were actively shifting money between different groups, maybe encouraging speculation, changing where the money slowed.
But Poole went back to the source material, the actual meeting transcripts.
He did. And looking at those FOMC transcripts from 2010, Poole says he reaches a different conclusion about Honig's main worry. Poole acknowledges Honig did talk about allocative issues, how resources were being directed. But Poole concludes, Honig's concern was not primarily about distributional issues, the rich getting richer versus the poor. It was more fundamental.
Okay, so another point of disagreement based on interpreting the evidence. This seems to lead into another major issue Poole has with the book, the cause of the 2008 financial crisis.
Right. Poole says both Honig, in his speeches, and Leonard's book sort of take it as given that the Fed's monetary policy was the main culprit behind the 2008 meltdown.
But Poole thinks they're missing key evidence.
He argues they are. He points first to the official Financial Crisis Inquiry Commission report, the FCIC, from 2011. The majority report actually blamed the Fed's lack of tough enough regulation. That's already different from blaming low interest rates.
Okay, inadequate regulation, but there was also a minority view.
Yes, and this is where Poole puts a lot of weight. He highlights the FCIC Minority Report, written by Peter Wallison, and Wallison's later book, Hidden in Plain Sight.
And Wallison's argument is?
Wallison argues, based on what Poole calls extensive evidence that holds up to scrutiny, that the crisis wasn't primarily about Fed monetary policy or just general lack of regulation. Instead, he traces it back to a specific HUD regulation from 1992.
A housing regulation.
Exactly. This regulation essentially forced the government-sponsored enterprises Fannie Mae and Freddie Mac to meet quotas for buying weaker subprime mortgages as part of an affordable housing initiative.
So Poole endorses Wallison's view. Government housing policy, pushing Fannie and Freddie to buy risky loans, was the real driver of the crisis.
That's his position. And he's quite critical. He actually uses the term scholarly malpractice, that Honig and Leonard seem to completely ignore the FCIC reports and Wallison's detailed work.
Strong words.
Very. He emphasizes Wallison's point. Look, it takes two to tango. Fannie and Freddie were the massive lenders buying these loans because HUD required it, and everyone assumed they had government backing. They nearly collapsed and had to be taken over by the government in 2008.
And Poole connects this back to Honig's inflation fears.
He does, adding a note from early 2022, observing that Fannie and Freddie were still heavily involved in the housing market, which was seeing prices jump almost 20% year over year. He sees that as consistent with the kind of asset inflation fueled by easy money that Honig worried about.
Okay, a very different explanation for 2008. Let's talk more about inflation. Poole makes a distinction between goods price inflation and asset price inflation, right? He thinks Leonard mixes them up.
Yes, he feels Leonard sometimes blends the two concepts. Leonard does describe how rising asset values, things like farmland, commercial real estate, oil rigs used as collateral, were alarming bank examiners like Honig.
Because it encouraged risky lending.
Right. Aggressive lending based on inflated collateral. Leonard also notes how low rates can hurt savers and push banks to take more risks, moving out on the yield curve, seeking higher returns. He quotes Honig referencing the 1970s, warning that when inflation eventually stops, these inflated asset values can collapse, leading to crisis upon crisis.
But Poole sees a key difference in that 1970s example.
He does. Poole stresses that in the 1970s, it was high goods price inflation. The cost of everyday stuff going up that was fundamentally driving up asset prices. When Paul Volcker's Fed finally crushed that goods inflation, asset prices corrected, often painfully.
So the tricky part is when asset prices rise without high goods inflation.
Exactly. That's the real monetary policy conundrum, Poole suggests. Think about the dot-com stock bubble in the late 1990s. Asset prices soared, but overall consumer price inflation was pretty moderate.
And this loops back to the instruments and goals problem.
Absolutely. It begs the question, does the Fed have enough separate tools to manage employment and goods price inflation and potentially destabilizing asset price bubbles all at once?
Poole's answer seems to be probably not.
Implicitly, yes. If you mainly have one big lever, the short-term interest rate, and you're trying to hit 3 different targets, you're likely going to miss something. Poole believes Honig, back in 2010, was primarily afraid the Fed's path would ultimately lead to broad goods price inflation, like we eventually saw in 2021-2022.
Okay, so let's talk explicitly about the Fed's tools. The Fed has official goals, right? Mandated by Congress.
Yes. Things like maximum employment, stable prices, and moderate long-term interest rates, often summarized as full employment, price stability, and financial stability. Though Poole notes the definitions can be a bit vague.
But how many effective instruments does Poole think the Fed has for the big picture, the macro economy?
Poole is very clear on this. He asserts the Fed really only has one primary instrument that reliably affects the overall macroeconomy, the short-term interest rate it controls, like the federal funds rate target.
What about other things like managing the money supply or quantitative easing?
He acknowledges the historical debates about targeting money supply or credit growth, and QE, those large-scale asset purchases, or LSAPs, certainly happened. But his core argument is that for steering the broad economy day-to-day, year-to-year, the short-term interest rate is the main game in town.
And this tool has limits. Monetary policy can't just fix everything in the real economy.
Right. Poole points out, monetary policy generally can't affect long-run real things like, say, the sustainable rate of unemployment, what economists call NRU, or population growth, productivity trends, immigration patterns, or the distribution of income.
But there's a big however.
A huge however. While the Fed might not target those real variables directly, Poole stresses that inflation itself absolutely does damage the real economy. It creates inefficiencies, it creates inequities, it can lead to financial instability. So if Fed policy causes inflation, it definitely impacts real outcomes.
So what about those distributional goals Leonard emphasizes? Can the Fed use its interest rate tool to make society fairer, reduce inequality?
Poole's answer is a hard no. He argues the Fed simply doesn't have the right tools for distributional goals, and frankly, it's the wrong institution for that job.
Who should handle that, in his view?
Congress. Using tax law and fiscal policy. Those are the appropriate tools and the appropriate body for addressing income distribution, according to Poole.
What about something like the trade balance? Sometimes that gets mentioned in Fed discussions.
Same logic applies. Poole argues trying to use the single interest rate lever to manage the trade balance would inevitably compromise the Fed's main job of stabilizing inflation and employment.
You keep coming back to. You need enough tools for the number of targets you have.
Okay, let's talk about that third goal. Financial stability. How does Poole define financial instability? It's not just markets going up and down.
No, he's careful to distinguish it from normal market volatility. He defines it as damaged market functioning. Think of crucial markets seizing up.
Like the examples he gives.
Right, like the commercial paper market freezing after the Penn Central Railroad went bankrupt in 1970, or the credit markets locking up completely when Lehman Brothers collapsed in 2008. He also notes large-scale bank failures, like in the Great Depression, are particularly destructive.
And the Fed often steps in during these crises.
It does, often acting as the lender of last resort to provide liquidity. But Poole immediately flags a risk of moral hazard here.
The idea that bailouts encourage future risk-taking. Exactly. If markets expect the Fed to always ride to the rescue, they might not be as careful themselves. But then Poole makes a crucial point. There are other tools outside the Fed's direct control that could promote financial stability. Banking regulation, specifically capital standards, how much of their own money banks have to hold against potential losses. Poole argues these were definitely too low heading into 2008.
How does he know they were too low?
His evidence is simple. So many banks got into trouble or failed that the standards had to be raised afterward. He even suggests they might still be too low.
Any other non-Fed tools?
He mentions potential changes to corporate income tax law. For instance, reducing or getting rid of the tax deduction for interest payments companies make on their debt.
That would discourage excessive borrowing.
Precisely. Or maybe allowing companies to deduct dividend payments to shareholders, making equity financing more attractive relative to debt. Both could limit the buildup of excessive corporate debt, making the whole system less fragile.
And Poole's point is these options weren't really discussed.
Right. He notes that Leonard and the reviewers didn't seem to explore these alternative tools. Nor did Fed officials really push hard for reforms like significantly higher capital requirements or these tax changes.
Okay, let's bring quantitative easing back into the picture. Those large-scale asset purchases, LSAPs, after 2008, Poole does acknowledge the period before 2008, say from 82 onwards, was generally pretty stable, right?
Yes, he notes that after the Volcker recession broke inflation in the early 80s, the economy generally saw recovery, lower inflation, and sustained growth up until 2008. The Fed managed occasional hiccups using its interest rate tool, crucially while keeping inflation expectations anchored.
And stable expectations helped.
Immensely. Poole argues that stable inflation expectations actually made the single interest rate tool more effective, allowing it to help stabilize both inflation around its target and offset temporary wobbles in the real economy. It also fostered an environment conducive to tech advances and growth.
But then came QE, and Poole feels Leonard and others missed the mark in analyzing it.
He comes back to his main critique. They didn't fully grapple with the Fed's limitation, basically one main macro tool. And regarding the huge expansion of the Fed's balance sheet from buying all those assets,
Yes.
Poole argues Leonard and the reviewers didn't focus enough on the potential instability this created. He thinks they got too caught up in the distributional aspects and didn't sufficiently analyze the really big issue, which he sees as the inflationary potential of these massive interventions.
Which brings us, inevitably, to the inflation spike of 2021-2022.
Right. Poole sees clear negative distributional consequences there. It punished conservative savers, people holding cash or bonds, while rewarding borrowers, especially those with leveraged mortgages, as inflation eroded the real value of their debt.
And he connects this back to housing.
Yes, he points again to that strong housing demand and soaring prices in early 2022, despite the price increases. It echoes Honig's warning, referencing the 70s, about how inflationary environments distort asset values.
Poole's core complaint about the Fed continuing QE for years after 2010 seems quite specific.
It is. He essentially asks, why did the FOMC keep doing these massive LSAPs when there wasn't clear evidence they were actually working as intended specifically, boosting business investment and overall GDP growth?
He cites specific evidence on this.
He mentions a March 2010 FOMC staff memo that apparently acknowledged LSAPs did seem to lower long-term interest rates, but, crucially, lacked any analysis showing this translated into more business investment or faster GDP growth.
And his analogy for continuing the policy anyway is memorable.
He calls it medical malpractice, like a doctor continuing a treatment without understanding why the patient isn't getting better or if the treatment is even helping. He says his own review of Fed materials through 2016 found no convincing studies explaining why QE wasn't boosting the real economy more.
Does Poole offer his own explanation for why business investment was weak after 2009, even with low rates?
He does offer a hypothesis. He suggests maybe the problem wasn't monetary policy, maybe the bottleneck was elsewhere in the government, regulation. He posits that federal regulatory agencies, he names the EPA, FERC, DOT as examples, might have been hindering growth by delaying or denying permits for necessary infrastructure and business development projects.
He has research on this.
He points to papers he wrote in 2011 and 2014 using the long-delayed Keystone XL pipeline as a high-profile example of regulatory hurdles potentially stifling investment.
And he contrasts this environment with the early 1980s recovery.
Yes. He argues the investment boom in 83-84 has several advantages. Falling inflation, tax incentives from the 1981 Kemp-Roth tax cuts, perhaps a less intense focus on regulation at that moment, and a military buildup providing stimulus. He suggests these positive factors were largely absent after 2009, which instead saw, in his view, heightened regulatory scrutiny and opposition to many development projects.
And the Fed didn't investigate this possibility.
Poole feels the Fed never seriously looked into whether the regulatory climate was acting as a brake on the recovery, despite him putting forward what he calls a viable hypothesis. He's careful to say his explanation is probably only partial, and more research is needed, but he thinks it was overlooked.
Okay, let's circle back one last time to that second narrative in Leonard's book, The Rexnord Story. Poole takes issue with Leonard's claim that financial engineering was key to Rexnord's strategy, right?
He does. He directly challenges that by pointing to the company's own public filings, specifically its 2020 10K annual report.
What does the report show?
Poole highlights sections emphasizing Rexnord's focus on innovation, new product development, R&D, and patents. He even lists the numbers. 21 new U.S. non-provisional patents, 6 provisional, 30 foreign patents just in 2020. He also points out the report details their global operations, 46 facilities, 14 main manufacturing plants, large warehouses, 23,000 employees across many countries.
So Poole is saying Rexnord was a complex, innovative manufacturing company, not just a vehicle for financial engineering.
That seems to be his point. He questions if Leonard actually dug into these detailed company reports, suggesting they paint a picture of a real operating business, not just leveraged buyouts.
And the link Leonard draws between Honig and Rexnord via Jerome Powell. How does Poole see that connection?
Poole is quite dismissive. He concludes that apart from Powell being involved with both Carlyle, which owned Rexnord for a time, and the Fed, where Honig served, Leonard presents no substantive connection whatsoever between the Honig dissents and the Rexnord story.
Leonard doesn't show how Powell's business experience influenced his Fed decisions.
According to Poole, no. He says Leonard makes no attempt to demonstrate how Powell's experience at Carlyle, dealing with companies like Rexnord, actually informed his thinking or actions as a Fed governor or chair.
What about Leonard calling Powell the fixer, the guy connecting Washington and Wall Street?
Poole sees that label as purely negative, essentially argument by innuendo. He feels it's designed to cast Powell in a certain light, without providing concrete evidence in the book linking his private sector work to specific policy choices at the Fed that benefited, say, big capital.
Okay, this leads to Poole's overall take on the book's accuracy. He doesn't mince words, does he?
No, he pulls no punches. His conclusion is stark. He claims there are so many errors of fact and misleading statements that he seriously doubts any rigorous fact-checking took place before publication.
Does he give a concrete example of an error?
Yes, a pretty clear one involves monetary policy itself. Leonard describes the Fed raising interest rates in 1999. The total move was less than 1 percentage point, from 5.7% to 6.5%, over several meetings as hitting the emergency brakes.
And Poole disagrees.
Strongly. Poole points out that the Fed's tightening cycle just a few years earlier, in 1994 and 1995, was much more aggressive. Rates went up a full 3 percentage points then, including large single hikes of 75 basis points and 50 basis points. Calling the smaller 1999 move hitting the emergency brakes, Poole argues, shows Leonard's analysis of monetary policy is simply unreliable.
Poole even critiques the publisher's promotional text.
He does. He takes aim at the blurb from Simon & Schuster, calling parts of it simply incorrect. For instance, the claim that the book shows Fed policies under Powell accelerated income inequality. Poole flatly states the book provides no data to back that up.
And another claim from the blurb.
The idea that once the Fed printed all that money through QE, there was no way to withdraw it. Poole refutes this directly using the Fed's own published data. He points out the Fed's total assets actually shrank by 17% between early 2015 and mid-2019, and the monetary base, the core money the Fed creates, fell even more sharply by 48% between August 2014 and September 2019.
So the Fed demonstrably did withdraw money it had created.
Exactly. The data shows it's possible, and it happened.
So we have a former Fed insider delivering a really stinging critique of this book's main arguments, its evidence, even its basic facts. Does Poole point readers towards sources he finds more credible?
Yes, he does. He specifically endorses Peter Wollaston's work again, the FCIC Minority Report, and his 2015 book, Hidden in Plain Sight, as offering a persuasive explanation for the 2008 crisis. He also gives a strong recommendation for Paul Tucker's 2018 book, Unelected Power, calling it a deeply informed and responsible look at central banking.
Okay, so wrapping this up, what does this all mean for you, the listener, trying to make sense of the Fed and the economy? We've definitely seen a clash of narratives here. You have Leonard's book, which, as reviewed by Poole, paints a picture of power, distribution, and a Fed potentially doing harm.
And then you have Poole, the insider, pushing back hard. His critique focuses on the Fed's limited toolkit, offers a very different cause for the 2008 crisis, pointing fingers at housing regulation, not just monetary policy, and expresses deep concern about policies like QE being continued without solid proof they worked, potentially paving the way for the inflation we saw.
And here's where it gets really interesting, I think. Consider Poole's core argument. Remember the tanker without reverse gear. That the Fed basically has one main instrument for the macroeconomy, the short-term interest rate.
Right. And trying to use that single tool to hit multiple, sometimes conflicting targets like full employment, stable prices, and maybe asset bubbles or distributional fairness. Well, Poole argues that guarantees you'll fail on some of those objectives.
Just think about that principle. The number of policy instruments needs to match the number of policy goals. What does that suggest about the broader challenges facing policymakers, not just at the Fed, but in government generally, when they try to tackle complex economic and social problems with perhaps too few or the wrong tools?
It raises a really important follow-up question, too. If Poole is right, or even partially right, that some of the biggest economic challenges, like the root cause of the 2008 crisis, or the reasons for sluggish investment after 2009, lie in areas like housing regulation, permitting rules, or tax policy.
Areas managed by Congress or other government agencies, not the Fed.
Exactly. What does that tell us about the inherent limits of what monetary policy alone can achieve? And doesn't it highlight the need for perhaps more coordinated, or at least considered, action beyond the Federal Reserve to tackle these really complex, multifaceted economic problems? Something for you to definitely mull over next time you hear debates about the economy and what the Fed should or shouldn't be doing.